Good morning. It is Friday, February 13th, 2026. Zach Howard in the week. Market update. Couple things here. Talk about AI, US CPI, and how that relates to the macro themes going into March, setting up for those plays. First up, DeepSeek Moment 2.0. Another AI startup. I hadn't heard of this one. MiniMax 2.5 came out earlier this year, backed by Alibaba, Tencent, I believe, basically coming out saying the data independent audits of Anthropic, OpenAI, Google's Gemini, this thing is scoring much higher at a much cheaper cost. OpenAI is in real trouble, I think, in this race, this arms war, this technology war, because they have so much money thrown at this AI with not a lot of the return on investment in the foreseeable future. Yet these Chinese models are already kicking their ass, and the OpenAI guys have to keep raising more money. So keep that on your radar as I think capital continues to come out of some of these mega cap names in the US as more rational thinking about what's been priced in versus reality. Coming out coincidentally enough here on the news that the Pentagon in the US says Alibaba, BYD, and Tencent also, I think, or Baidu are known Chinese military companies. Well, no shit. Thanks for coming out, guys. How about Powder? All these other tech companies in the US is basically the same game we're using against each other. That's the reality of it. Were we not paying attention to anything this week? I think probably is going to go down in history as one of the cringe moments of where society really applied towards in the US, particularly financialization, when Pam Bondi said it doesn't even matter as long as the stock market is up. That famous will be famous for a foreseeable future. The Dow was 50,000. Quote, just disgusting that was, and really speaks to where we're to with all this forced turning stuff. Into the CPI into the US here today come out. Much lower number than expected. Data here with probably the greatest forecasters on the street. Forget the old wall, JP Morgan's, Goldman Sachs, hedge eyes modeling had nailed this one. And they got set up for disinflation, pivoted asset classes that would benefit from this here now. January 2.39 headline number versus 2.68. That's a massive rate of change slowdown. Really driven off lower energy prices. Core goods was much lower as well. Rate of change slowdown from September, November, December into 1.12. That is really driving it. Markets move off the rate of change, not the absolute, and that's where the puck is going. Shelter components come down as well. However, I think really the issue is the commodities are going to have a opportunity to set the next play up for March, rate of change positive with this bump up in energy, metals, and now we're seeing potentially here today, the Trump administration says no longer tariffs on aluminum and some other core key commodities because markets move off of the rate of change, as I mentioned, but also now the base effect. So because this number here for US CPI has fallen so much, November, December, January, February, expected to start going back up again in March, and we're probably going to get stagflationary pressures, which gold is really going to love. We're seeing here off that CPI data today, the US bond yields, the 30-year, the 10-year, the 2-year, all coming down, lower lows, lower highs. Bonds going up because those yields coming down. Gold loves that. And that's what I pointed out a couple of weeks ago. You look at the chart of gold versus correlation to real yields over the last 5 to 7 years, setting up for Fed rate cuts ahead in 2026. $5,000 round number again back on gold. Silver rallying here to end the week. MegaCap Tech still under pressure. Commodities is where it's at. And that's where I see the trades. Have a good week and see you next week.